Silver has just made one of its most aggressive moves in recent memory, and the conversation across trading desks in New York and Chicago has shifted almost overnight. After surging sharply in the latest US session, spot silver is now trading near the mid-90s per ounce, with futures on Comex, operated by CME Group, pushing into the low to mid-$90 range as well. The psychological question echoing through the market is no longer whether silver is in a bull phase, but whether the metal can realistically challenge the $100 per ounce level. That number is no longer a distant fantasy target. It has entered serious discussion among institutional traders, commodity strategists, and macro funds. The rally has not occurred in isolation, and it has not happened without reason. It is the product of macroeconomic shifts, monetary policy expectations, investor positioning, industrial demand growth, and renewed geopolitical stress. The key question now is whether this surge represents the early stage of a structural breakout or the kind of vertical move that invites a sharp correction. As of this week, spot silver in the US market is trading around $95 per ounce, reflecting a daily gain of roughly 1.5 to 2% and a weekly advance that has exceeded 5%. On the futures side, the most active Comex contract is holding near $93 to $96 per ounce depending on the session, marking a significant breakout above prior consolidation zones in the mid-80s. According to recent reporting from Reuters and Bloomberg, trading volumes have expanded meaningfully during this rally, confirming that this is not a thin, low-liquidity move, but one backed by strong participation. Exchange-traded funds tracking silver have also recorded renewed inflows. Several large silver ETFs saw multi-day inflow streaks, with assets under management rising as institutional and retail investors sought exposure to precious metals amid rising macro uncertainty. While inflow percentages vary by fund, the broader trend is clear. Capital is rotating into silver alongside gold. ETF positioning often acts as a leading indicator of sustained investor conviction, and the current flow data suggests this rally is not purely speculative short covering. To understand why silver has moved so aggressively, we have to begin with the macro backdrop. The latest inflation data from the U.S. Bureau of Labor Statistics shows that price pressures remain persistent. Recent CPI and PPI readings came in above expectations, reinforcing the narrative that inflation is moderating more slowly than policymakers had hoped. Producer prices, in particular, surprised to the upside, indicating that input costs across industries remain elevated. Persistent inflation alters the risk-reward calculation for investors. Real yields become more volatile, and the appeal of hard assets strengthens. At the same time, the policy outlook from the U.S. Federal Reserve has grown increasingly complex. While the Federal Reserve has signaled a data-dependent approach, markets have been actively repricing the timing and magnitude of potential rate cuts. Treasury yields have fluctuated sharply in response. The 10-year U.S. Treasury yield, after pushing higher earlier in the quarter, has recently stabilized and shown signs of retreat as traders reassess growth and inflation dynamics. Lower or stabilizing yields reduce the opportunity cost of holding non-yielding assets like silver, providing additional support. The US dollar index has also played a central role. The dollar experienced strength earlier in the year, which typically acts as a headwind for commodities priced in dollars. However, in recent sessions, the dollar's upward momentum has slowed, and modest pullbacks have coincided with silver's breakout. A softer dollar makes dollar-denominated commodities more attractive to global buyers, amplifying demand. Geopolitical developments have added another layer of complexity. Rising tensions in key regions have driven safe haven flows into precious metals. While gold traditionally captures the bulk of risk-off demand, silver often follows, benefiting from its dual role as both a monetary and industrial metal. Reports covered by Reuters and Bloomberg indicate that renewed geopolitical uncertainty has contributed to heightened volatility across commodities, equities, and currencies. In that environment, silver becomes part of a broader defensive allocation strategy. But silver's story is not purely macroeconomic or geopolitical, it is also fundamentally industrial. Unlike gold, more than half of annual silver demand is tied directly to industrial applications. Solar panel manufacturing continues to expand globally, with photovoltaic installations reaching record levels. Electric vehicle production requires silver for electrical contacts and battery management systems. Consumer electronics, 5G infrastructure, and semiconductor manufacturing all consume meaningful quantities of silver. Industrial demand growth has been particularly strong in renewable energy sectors, where silver's conductivity and efficiency characteristics make it difficult to substitute. At the same time, supply growth has not kept pace. Mining output has faced constraints due to declining ore grades, permitting challenges, and capital discipline among producers. Several industry analyses have highlighted ongoing structural supply deficits in the silver market, meaning annual demand exceeds newly mined and recycled supply. These deficits do not always immediately translate into price spikes, but over time they tighten inventories and increase price sensitivity to demand shocks. When we connect these factors, the recent surge begins to make sense. Persistent inflation supports the case for hard assets. Stabilizing or declining treasury yields reduce headwinds. A softer dollar improves global affordability. Geopolitical stress enhances safe haven appeal. Strong industrial demand tightens the supply-demand balance. ETF inflows confirm investor participation. Together, these forces create the conditions for a powerful rally. From a technical perspective, the breakout above the $90 level was critical. For months, silver had consolidated below that zone, encountering repeated resistance. The move through $90 triggered momentum buying and likely forced short sellers to cover positions. Once that level cleared, the path toward the mid-90s opened quickly. Momentum indicators such as the Relative Strength Index have moved into elevated territory, reflecting strong buying pressure. Volume expansion during the breakout reinforces its credibility. The next major psychological level is $100 per ounce. Psychological round numbers often act as magnets for price action. However, reaching $100 would require continued alignment of bullish catalysts. For silver to sustain a move from the mid-90s to triple digits, several conditions would likely need to persist. Inflation would need to remain firm or re-accelerate, reinforcing the store of value narrative. The Federal Reserve would need to signal or implement a more accommodative stance, putting downward pressure on real yields. The dollar would likely need to weaken further, industrial demand would need to stay robust, and geopolitical tensions would need to remain unresolved. At the same time, risks to the upside scenario must be acknowledged. Silver is historically volatile. Its market size is smaller than gold's, making it more susceptible to sharp corrections. If inflation data unexpectedly cools, Treasury yields could rise again as markets push back rate cut expectations. A stronger dollar could reintroduce headwinds. If geopolitical tensions ease, safe haven flows might unwind. Additionally, after a multi-week rally exceeding 5% in a short period, profit-taking is a natural possibility. Key technical support levels now sit near the breakout zone around $80 to $90. A sustained hold above that area would confirm the breakout structure. Below that, stronger support may emerge in the mid-80s, where prior consolidation occurred. Resistance is clustered near the recent highs in the mid-90s, and then at the $100 psychological barrier. The base case outlook over the next 1 to 3 months leans cautiously bullish but acknowledges elevated volatility. As long as macro conditions remain supportive and real yields do not spike meaningfully higher, silver has room to test higher levels. However, the pace of ascent may moderate. Markets rarely move in straight lines. Consolidation between $90 and $100 would not invalidate the broader uptrend and could in fact strengthen it by allowing momentum indicators to reset. For traders, monitoring Federal Reserve communication is essential. Policy statements, meeting minutes, and speeches can quickly shift rate expectations. Watching inflation releases from the Bureau of Labor Statistics will remain critical. Observing movements in the 10-year Treasury yield and the US dollar index provides real-time insight into macro pressure points. Tracking ETF flows offers a window into investor sentiment. Keeping an eye on industrial production data and solar installation figures can help gauge demand sustainability. Ultimately, the silver rally reflects more than a single catalyst. It is the convergence of monetary policy uncertainty, inflation persistence, supply constraints, industrial growth, and renewed defensive positioning. The $100 level is ambitious, but no longer implausible. Whether it is reached in the coming months will depend on the durability of the forces currently supporting prices. For now, silver remains in a confirmed bullish phase with strong momentum, supportive macro cross-currents, and structural demand backing. Yet the very strength of the move demands disciplined risk management. The coming weeks will determine whether this breakout matures into a sustained advance toward triple digits or pauses for consolidation. Investors and traders alike should remain focused on the data, because in markets like this, the direction of the next move will be decided not by speculation, but by measurable shifts in inflation, yields, currency dynamics, and global demand.